Guys, you would think with these bailouts of American banks and Credit Suisse Bank in Switzerland that the worst is over. However, the market doesn't seem to be acting that way. So let's take a look at what happened this week and where we are now and what the market is telling us about indications on where we are potentially going. So, as usual, Zero Hedge has a really good market wrap up article. Bonds, Bitcoin, and bullion soar as global bailouts fail to stem bank runs. So, even with the Swiss government bailing out Credit Suisse, their credit default swaps for 1 year, meaning basically insurance on their bonds defaulting, has not actually come down. It is still elevated around 33% per year. And it's not just Credit Suisse, USA sovereign credit risk. This is at levels higher than the great financial crisis, the US ratings downgrade, and the debt ceiling around 2013. We are definitely not out of the woods. Something is still breaking, it seems. And it looks like investors don't think regional banks are out of the woods yet. This is when the so-called bailout was announced, and look, they are still trending lower. And that's First Republic, Western Alliance, Zions, Comerica, Huntington Bank Shares, and PacWest Bank Corp. And looking at a chart of Credit Suisse, this is when the Saudi bank said they're not going to put any more money in. This is when the Swiss government said we are going to put money in, 50 billion or more. And this is Credit Suisse stock price from going up to almost 270 on that good news, now back down to around $2. So people aren't believing that they are out of the woods. And even First Republic Bank, who a bunch of big banks said that they're going to put $30 billion into it. That news was this green section here where it rallied from 20 to about 40. Now it is all the way back down to $23. So again, investors aren't believing that First Republic is out of the woods. And so what is doing good in this time of uncertainty and turmoil? Well, gold here in orange, Bitcoin in green, and generic government 10-year bonds in blue over here. And so very surprising, gold is up around 1980 when it was under $1,900 on March 15th, just 2 days ago. Bitcoin as well, above $26,000. And the 10-year yield is all the way down to about 3.4%. Now, in my opinion, if the screws keep turning on the financial system, I would rather be in gold and 10-year treasuries than Bitcoin, because I think at one point, if everything else is falling apart, people are going to start shaking their head and saying, what makes Bitcoin an actual safe haven? But that's just me. And so I think this is very surprising to a lot of people, but the difference between the NASDAQ, the S&P 500, the Dow, and the small caps are pretty surprising. So the NASDAQ ended up about up 5.7% on the week, with the S&P 500 up about 1.3%, with the Dow just about zero at minus 0.267%, but the small caps, Russell 2000, down 2.7%. And so, like they say, that is a huge outperformance of mega cap tech over small caps. That's practically unprecedented. As Goldman Sachs notes, over the last 10 sessions, the GS basket of mega cap tech stocks is up 6.2%, and the Russell 2000 over the same period is down 9.8%. And so that 16% spread is the second highest of all time. And so here is a chart of the difference in that spread going all the way back before 2014. And only one time here during the pandemic did it get above that level that it is at now. And going back to the end of 2022, we see the extreme opposite, where the 10-day performance spread was a difference of 20%, meaning the Russell 2000 was beating the NASDAQ by 20% over a 10-day period. So they're saying there's been a clear shift to tech stocks and an even more clear shift to the ultra high market capitalization names. And this is kind of a flight to quality. People are just going with big safe names like the Microsofts and the Amazons and the Googles and that kind of thing. And the S&P 500 could not break above the 200-day moving average, and it's below that, as well as the 100-day and the 50-day. And looking at the performance of different sectors during the week, we see oil is actually the worst performer at minus 7% on the week. So this is telling you that a lot of people believe that demand is going to collapse with the upcoming recession. And so a lot of people are lightening up on oil, except for Warren Buffett, who bought more Occidental apparently, but it's doing worse than actually the financial sector. And the best performers were technology at 5% up on the week, and second place, utilities 3.4% up on the week. And if you didn't lose money fast enough this week in oil stocks and bank stocks, then you might want to look into office REIT stocks, which some of these are down from 20% to 30%, like Hudson Pacific Properties. And as for the VIX, the volatility index, it is down from the high above 30, but it is still very elevated at 26. And so in treasuries, the yield curve is flattening out because the 2-year treasuries are down 75 basis points, whereas the 30-year are only down about 11 basis points on the week. And if you didn't know that this was a chart of the yield on the 2-year government treasuries, you would think that this is some kind of really volatile tech stock, because from March 9th, it was yielding around 5%. It fell all the way down to 4% by March 13th, back up to 4.5, back down to 3.8, back up to 4.2, and now back down to about 3.9. So a pretty wild ride. This is not normal. And looking at this chart of the spread between the yield on the 30-year versus the 2-year, the difference in December was only 40 basis points. By late February, it was minus 120 basis points or 1.2%. And just in the last few days, the 2-year yield has fallen so much, but the 30-year yield has not. And so the yield curve has flattened out almost to the point of zero. But right now we're sitting at minus 36 basis points. So why is that important? Because an inverted yield curve usually means a recession is coming, and usually right before the recession comes, it uninverts or it flattens out. So you see that here, you see that here, you see that here, right? The green is the 2-year, the red is the 30-year, it inverts, and then at the recession, it uninverts or flattens out. And the dollar index spiked from the lows over here to over 1255, but now we are back down around 1245. So not much net movement during the week, and yet gold has kind of broken out from here. So it is not up because of dollar weakness so much as a flight to quality, it looks like. And if you want to call this a flight to quality of Bitcoin and Ethereum being up 32 and 21%, I guess you can call it that. Now, you don't have the same percentage moves with gold, but it is up about 3% on the day, and it has now reached the highest level since April of 2022. And this is when Russia invaded Ukraine right here in February, this spike above 2100. So it looks like we are creeping up, soon to be over 2000, it looks like. And so silver is up 9.5%, gold up 5.9% on the week, with oil down about 13% on the week. And this crude oil chart of the continuous contract is not looking very good. It's back to the lows all the way of January of 2022. And the rate change expectations going out to different months is seen here. So going out to March, they're expecting the rates to increase by 0.148 to May 0.29. But after that, they are expecting rates to be lower. So they're expecting one more rate increase and then cuts starting probably after May. So this graph explains the now interest rate expectations of the market. This orange line was March 9th, post Powell speaking. And so the terminal rate on this old news is above 5.5%. The terminal rate now on what's going on in the market is probably about, what, 4.7%? And so just a few days ago, they were expecting that for rates to finally get lower than where they are now is going to take all the way down to September of 2024. But now, how long is it going to take for rates to get lower than where they are now? Well, that is right here. And that is around July of 2023. So in other words, just a few days ago, they expected terminal rates to be a little bit over 5.5, and they would drift lower all the way to 2024 to the point where they would be lower than they are now. On this new graph, just a few days later, after bank blowups and bailouts and all of this stuff, they're now expecting the terminal rate to be almost where they are right now. And in just 2 months, they're going to be lower than where they are now and continue lower to the point where by a few months into 2025, they are going to be about 2.75%, whereas the old graph was saying by this same date, they would still be above 4%. So that is a huge difference in Fed funds expectations in just 1 week. So guys, you see this market that everybody thinks is orderly and safe can go from that to very disorderly and things breaking and things getting out of whack very quickly. Even with these bailouts in the last few days, it seems that somebody knows that it is apparently not enough and there are more things lurking that are going to come out, it seems, to wreak havoc on the financial system. Now, this is not financial advice, just what I'm doing. I'm trying to stay very conservative by just staying in money market funds, treasuries, that kind of thing, and wait to see how this plays out because I don't think we are at the bottom. Maybe when I see the VIX spike above 40, 50, 60, something along those lines, that may be a temporary spike down. Who knows? But don't try to pick the bottom with all your money. Don't try to catch a falling knife. It seems that there are still some things out there that we don't know about yet, and things could still get worse from here. So make sure you're diversified with not only your money, but your bank accounts, your brokerage accounts, have multiple different ones just in case, because you never know what's going to happen. Maybe have some precious metals, have some real estate, have some supplies in your house. Who knows how long this is going to go for. Thanks for watching, guys.